Well, folks, we're here today to talk about the 5 different life insurances. The reason why this is so important is because most people think there's only two. Everyone here is term life insurance and everyone here is permanent life insurance. But in actuality, we have 5, which is whole life, term life, universal life, variable universal life, and index universal life. So what's the difference? Well, allow me to explain. Everyone knows term life insurance. It's the most affordable, it's the cheapest life insurance out there. It normally takes care of a time frame. It could be in increments of 5, from 5 years, 10 years, 15 years, all the way up to 30 years. Some of them have 35 years policies that you could have for these term life insurances. Very great to have to make sure you could take care of something in those time frames. If you're buying a house, you have mortgage insurance. Some people get term life insurance for themselves. You know, you would have it where it's a decreasing term insurance. So if it's a 20-year, every single year it goes down the face amount coverage to actually have. So the pros and cons to term insurance is the pros is very affordable. A lot of times the con is 2 main things. Number one, 98% of time term policies do not pay out. Why? Because most people outlive their term policies. And number 2, if you want to have a renewal and do another term policy, guess what? Now you're 30 years older, it's going to cost a lot more. So those are some of the cons when you have your term insurance. Then you have your whole life, exactly what it's suggesting, to have something for your whole life. A lot of these are fixed. A company may give you 3%, 4%, 5% growth. You know, when your whole life policies, great policies to have if you want something that goes for your whole life. But generally speaking, you have 2 things to understand. Number 1 is a loan provision. Loan provision is how much it's going to cost to take money out of your whole life. Most of the time it's regularly between 3% to 7%. You may have a few companies that are more, but that's regularly the loan provision. But the big thing with whole life is you normally get either or. What that means is you have cash value that could grow in your whole life and you have a death benefit. Let's just say your death benefit is $100,000 and your cash value is $25,000. The company's going to pay out the bigger amount, which is the $100,000, and then they'll keep the $25,000 the cash value. So that doesn't give you both. Then you have your universal life. Universal life, people wanted to have a kind of a hybrid between both. They wanted something that was a whole life to last, but they wanted to have something affordable like a term. That's where universal life came out. It's kind of the in-between a whole life and universal life. So it costs a little bit more than your term life insurance. It costs a little bit less than your whole life insurance. But since it costs a little bit less, it grows a little bit less. A lot of your whole life policies have anywhere from, like I said, 3 to 5%, maybe 6% interest rate on the growth. Most universal life has a 1% or 2% growth. So you have a smaller amount to grow when it comes to universal life. Then you have something called a VUL, a variable universal life. Why? Because you know most people don't like that 0, 1, 2% growth that you have in your term in your universal life. So variable universal life came out, which is actually attached to the market. So when the market goes up 20%, you could get 20%. But when the market goes down 20%, you just lost 20%. But it still has the initial, was a little bit more affordable than your whole life, but it's actually attached to the market. So as you see over the years, they've actually been evolving life insurance. And the most current life insurance is what they call the IUL, the Index Universal Life. They're kind of taking all the pros from the first 4 life insurances and trying to eliminate those. So the Index Universal Life, it allows you to have an index funding saving strategy. Meaning there's a floor and there's a cap. If the market goes up 25%, you may have a cap at 13, 14, 15%. But if you have that index account, guess what? An index account has a floor. Most of the time, 0 is your hero. You might have a 0% floor or a 0.75% floor for some companies. So when you look last year at 2020, when your 401ks, your IRAs, your stocks was losing 18, 19%, you had that 0% floor. But when the market goes up, you were still able to utilize, because an index universal life is not in the market, it's a reflection of the market. So remember that life insurance is not an investment. People say it's an investment. No, it's not. It's a supercharged saving strategy, which you're allowed to borrow against to be able to use and have tax-free accumulation and tax-free growth. Now, yes, there is a cost. Everything is a pros and cons. You know, for a lot of these, you have what they call a COI, a cost of insurance. Now, cost of insurance, if you have a policy where you could overfund, like a lot of the IULs, where you could put in, say, $100 a month, or you could put in $1,000 a month. So you have a minimum and a maximum. The cost of insurance is always going to be the same. But let's just say, hypothetically, you owed $1,000, right? You owed $1,000 in cost of insurance, but you're paying $100 a month. If they're taking, say, 10%, what is that? That's $10 every month of your 100 is going towards the cost of insurance. So how many months is it going to take to pay off $1,000 if you're just putting $10 a month? That's going to take years. That's why you see people say there's a lot of cost of insurance and life insurance when it comes up front. That's because they're paying the minimum. Now, if it's structured correctly and you're paying the maximum, like I was saying for that example, now you're paying $1,000 a month instead of that 100. You're maxing out at 1,000. 10% of 1,000 is what? $100. So within that first year, you're taking care of that cost of insurance because you have more going towards the cost of insurance as you're overfunding. But would you rather pay a small little bit up front, or are you going to wait till when most people pay taxes when they need it the most down the road? So all 5 life insurances have pros, they have cons, they have different ways they could work for you. You just have to make sure you have the right one. You know, my main recommendation is saying you should have at least 2. You should have something that's a term, and you should have something that's a whole life strategy or a permanent strategy. Why? Because term life, always remember this, term life gets you to retirement, whole life gets you through retirement. Any kind of permanent life insurance is supposed to get you through your retirement, while you use your term to get you to there. So that is huge. Hope that clears up some things, and I'll break down each one a little bit more down the road. Let's max out.